Righto, g'day, Money Morners. Today, 25th of January. Right, today, boys, a bit of uranium mania. The two big U-dogs in Australia have reported their quarterlies, Paladin and Boss.
Can I just say, I've never heard anyone use the word Australia Day Eve in my entire life.
Mate, Australia Day Eve, Christmas Eve, bloody...
I haven't heard the term U-dog either.
You wait for Mackay Diva and the bloody Michael Clem YouTube videos going tonight. Can't wait, mate. MinRes quarterly today. We tuned into that call. Heap out of the Goldies. What do we got? St. Barbara, Regis, WAF, Calidus and Spartan. Big Kenny B is moving to Quebec. We'll go into that. And Arafura in limbo, or still in limbo?
Yeah, still in limbo.
Still in limbo. Right. Now, talk about some bloody great Australian companies before we get into the ones that are publicly listed. But, geez, there's some rippers that are private. One, I'll tell you what, boys, MMTS. You heard of them?
McMahon Mining Title Services.
McMahon, but I think they stand for something else.
Tell me.
What's that?
Manage mining tenements superbly, because that's what they do. That is it. I don't think it's actually McMahon Mining Title Services.
I think
you're
Manage
good.
mining tenements superbly. That's what they do.
You think you could bring this into, like, this could be their catchphrase. You know how, like, LG, no one knows what LG stands for except life's good, but, but it doesn't stand for life's good? Yeah.
Consider it done. Mate, I come across their advanced land monitoring systems, like, you know, the software that they've developed in-house to just know whenever a tenement becomes available in Western Australia, Northern Territory, and New South Wales. It's not your average off-the-shelf software. It's bloody MMTS engineered, designed, and cutting edge. And it's that big of a deal. This software even has the endorsement of some of the world's biggest financial figures
Jeff
that I've
Bezos,
come across.
Elon Musk.
I'll show you.
It is a cutting-edge, high-tech firm out of the Midwest awaiting imminent patent approval on a next generation of
Land monitoring system.
that have both huge military and civilian applications.
Is that the pitch we want to give to MMTS?
That's it. Cutting edge land monitoring systems.
Mate, it's a shame they're not public. Otherwise, I'd be buying stock right
Mate,
now.
when you got Jordan Belfort telling the world how good your land monitoring systems is, mate, there's just no doubt.
Yeah, that's
No
when you know
doubt.
you're good.
It's bloody, mate, they're even monitoring land becoming available in other jurisdictions. They got there are no-go zones for MMTS. They have that KCA attitude. No is not an option.
Thank
it's
you,
bloody
MMTS.
brilliant. Good on you, MMTS.
Manage mining tenements superbly. No one does it more superb.
Or sensationally. Manage mining tenements sensationally. Bloody legends. Right. Boys, I want to take you on another Brooks journey. Remember we went on a bit of a hypothetical Brooks journey
How could I forget?
last week?
Yeah. Every week.
We're about
every
to
day's
go
a
on
journey.
the other one. Because, this is for the people in the mining industry that have sort of taken their next steps towards financial freedom. Because in the FIFO world, you got a week off. Why not start a hobby farm? I know plenty of guys that get into farming in the break on their bloody...
Really?
Mate, once you start earning the big mining dosh, it's not enough. You just want to keep going. Exponential bloody financial growth.
This is like 9 months in, you got 3 jet skis and...
Exactly. Yeah. And now why not? Now we talk about the Brooks fleet, the Brooks Airways fleet that can land on the shittest runways for all your FIFO destinations. So why not? When you got one of these hobby farming aspirations, let Stewie know, mate, can you just drop us off to me farm on the way home? So look at this. You get on site, get on the Brooks flight, drop you off straight at your farm. Now, for farming, boys, you use the city. Oh, you're sort of country, but
country,
I come from a bit of the country background.
Not
so
farming,
mate, this is you got to fuel the joint up. You need a bit of diesel on site, so you can get your bloody Brooks fuel truck here, get your diesel to power the bloody Brooks generator because you want to power up that farm. You need a bit of power for your shed and all that, mate. Even after that, you need access because you got to get the fuel truck and the machinery in there. Get your Brooks grader to cut yourself a nice cambered bloody road going up to the property. Mate, you're going to be running cattle. You need dams. You need water for your cattle. Get a bloody Brooks excavator or a Brooks scraper to bloody dig the joint out. Mate, if you come past some bloody massive rocks that are just pissing you off, just chuck a Brooks rock breaker on the end of the excavator. And look, if those rocks are bloody just making the day go a bit longer than they should, just light the joint up with a Brooks light tower and get night shift onto it. Like, mate, there is no, mate, you can fuck the dirt off in a Brooks tipper truck, run the farm with a Brooks tractor, and, mate, nothing worse than having a bit of the dust getting in the cattle's eyes and that just pisses them right off. Mate, keep the dust down with a Brooks water truck, mate. There is, and because after you finish all that, you're working your ass off all week and you just want to get up and enjoy the countryside. Hop in a bloody Brooks 135-foot articulated boom lift and just get a view of the whole joint. Mate, talk about a full turnkey farming and aeronautical solution for Brooks Airways, Brooks Hire, Brooks Equipment, the Brooks Enterprise.
And this is before you have to fly back up to the mine site when your week's done.
Mate, then you go up, you got a bit of extra cash, buy some more Hereford on break. Bloody when cattle prices are bloody flying, you flick them off. Mate, just win-win. Mate,
I agree
Brooks
with you,
are
mate.
creating entrepreneurs everywhere, giving people opportunity.
You're the first one.
If this is what you get up to on your week off, I actually agree with you, Matty. Miners getting paid too much.
Mate, once you start going, it's like this. I'll be like, right, we're making money. Now, how do we make more? Good stuff. Cheers, Brooks Airways. And check
Cheers,
out
Brooks.
all the Brooks groups as well. Righto, boys.
You've outdone yourself.
The
by
yellow cake, what's going on? The uranium producers of Australia.
That was impressive, Matty.
What's that?
The
Your
energy.
advertising.
It was like, mate, you've literally taken it to.
Oh,
another
no,
level.
we're on to uranium now,
Uranium.
boys. Let's fucking get into it.
So they're not producers, mate. They're
Pre-Australia Day.
they're very near term produce. It depends how
Boss
you
is.
define a producer.
Boss producing now?
They produced first, uranium from its well, but it's not first barrel yet. I got to come up to speed with all the lingo, mate. But in my mind, until you sell something, I want first sales. But yeah, anyway, they're technically producing. But yeah, mate. Before I go deep on these two companies, Paladin and Boss, because both of them came out with their reporting today, and we just got to bloody reflect for a moment and just point out that uranium spot price is currently $106 per pound. That's wild. And hence there's probably a lot more interest in the uranium miners than there has been in the past, maybe ever. I don't know. Probably the boom in 2007 was the exception, but these two are, just right there at the cusp. So, and they're, for all intents and purposes, the biggest two companies by market cap on the ASX. I mean, technically, NextGen has a larger market cap, but their majority listing is it's a CDI in the ASX, and their main listing is in North America there. So, heck,
The boom's shaping up to be as big as a Brooks 145-foot boom lift. Like, that's how big this boom could be. We don't know yet.
the energy from the ad is just it's still with you.
I reckon that these ads got a pretty similar energy density to uranium.
That is 100% true, mate. You're on fire. You're radiating. So with all the market hype, I think like a relatively big factor in the price discovery of the stocks, though, is the impact of the uranium ETFs. That's new. That wasn't there last cycle, right? And there are the big thematic allocators of capital that want exposure to uranium. So they buy a uranium miner ETF to get diversified exposure. And those ETFs simply bid the stocks that meet the criteria of that ETF. And I think it has a funny impact on the market, right? Because like price discovery at the margin of these equities, these uranium mining equities, is coming from ETF flow rather than active managers of capital doing, a bottom-up valuation of these stocks. And that leads to some, kind of weird dynamics themselves. You see valuation metrics on these mining companies that make you scratch your head because they're metrics that you don't see for mining companies.
It's funny how you talk about ETFs, and I know I mentioned how the Bitcoin ETF come out. ETFs are coming out, and the fact that there's, as you said, these uranium ETFs, when you got all the old school the financial advisors allocating funds to all their clients, all the old rich people and everything, they're like, oh, why don't you have a bit of? They would never have gone and just bought a bloody uranium stock, but it's like, well, you should have 1% to 2% allocated maybe towards uranium ETFs, and it just, as you said, ETFs bring this whole new flow of money into this market.
Yeah.
Yeah, let's take a peek into those ETFs because we spoke about this with Guy Keller when was that, like 3 or 4 months ago now?
Yeah.
And he referred to the market caps slowly starting to get to a level. They weren't there yet, but they're getting to a level where they can attract institutional cash. I mean, just let's see when we get to $175, as he said, I think you'll see that cash really starting to come in. But looking at some of the numbers on the ETF, so people always mention the Sprott one. And Sprott is actually really milking it because they've got 3. So the first one is the Physical Uranium Trust, which we've spoken about a bit in the past. Now, this one just buys the commodity and stores it. So that has the impact on the market of just pushing up the commodity price because they're taking the commodity that would otherwise go to the power plants that would take it. That now has net assets of US 6.7 billion. So they hold 63.3 million pounds of uranium.
Wow. So that's what, 2 years worth of over 2 years worth of what next gen will produce if it comes on. So it's a lot of bloody uranium.
It is a very substantial amount of world supply.
They built a financial instrument to squeeze the market.
Yes.
Yeah. Pretty remarkable. Yeah.
Well, like
pretty deliberate as well.
The Cameco ones, what do they pump out? I think they're about 18 million pounds an annum, per annum.
They've got a lot on sort of care and maintenance stuff.
Yeah, so I think Cigar Lake was 18 million pounds. So
Yeah.
like that just to give people a bit of context of what 63.3 million pounds of uranium is. It's like over 3 years of production at one of the biggest ones in the world.
Yeah, and it took them a little while to build up to that level, but it's sort of flattened off now. So you've then got the Sprott Uranium Miners, which is not small either, almost $2 billion in net assets, US dollars, that is as well. And that has the impact you're talking about, Trav, of just going in and buying the stocks. Now, this one focuses on the larger caps. So I think about 85% of the companies they hold have market caps of over $2 billion. So they get into the chunky stuff. They hold 37 different stocks. And we're talking Kazatomprom, Cameco, CGN, those sorts of companies. They also have 15% of their assets in the other Sprott Physical Uranium Trust. Now, I think that's a bit cheeky.
Mate.
That's stretching
the spinning itself there.
stretching the definition of a uranium mining company there. And then you've also got the Sprott Junior ETF. So that focuses on smaller companies, as you could imagine. They've got US 270 million in assets. And you got a couple other players. You got Beta Shares and Van Eck as well. The Van Eck one was interesting, Trav, because you said this wasn't a sort of effect that was felt so much in the last uranium cycle. So I had a look when the inception date for this Van Eck one was. Now, it was in August of 2007. That was 1 month after the peak in the all-time high we saw in uranium prices. So that would have seen outflows for a long, long, long time and just stayed dormant. That has a couple $100 million in net assets now.
Wow. With and back to your point you made, Matty, on the allocation to the ETFs. I reckon the bigger contributor to flows might not actually be might not be the retail kind of component. There are sort of thematic hedge funds that will look to play momentum, and when you see momentum in a space like uranium, that sort of sometimes big pools of capital can flow there, but those big pools of capital are pretty fluid and they move pretty freely out as well, depending on where the thematic is.
If you globally bloody bring in every bloody pension fund and all that'll start getting exposure, I think the dollars will add up. Yeah.
So with respect to Boss and Paladin, I'll show you what I mean about funny metrics, right? Boss trades at 1.2 times consensus NAV, being net asset value, and Paladin trades at 1.3 times consensus NAV. Last time I really unpacked these broker reports, they were building in some funny stuff into those NAV numbers too to try and backfill value. So take the consensus NAV is being obviously the average of all of the brokers that write broker reports on them. The NAVs themselves with a bit of a grain of salt too, depending on what the incentives are or the conflicts are on the journey. But you kind of get the picture there. They're juicy, multiples of NAV that the equities are trading at right now. And to be clear, you normally see a developer trade at a reasonable discount to NAV, depending on how early the project is or the developer is in advancing their project. That discount to NAV is typically bigger. And then once a company goes through ramp up and is at kind of commercial production where you're past all of that really risky business, that NAV estimate should get progressively de-risked, so the discount to NAV shrinks and the company should theoretically converge to 1 times NAV. So when I look at Boss and Paladin and I see these two companies trade substantially above that, despite the fact ramp up risk is very much still present in both equities, is it's really, really rare. So I think those ETF dynamics explain that right now.
Right. So how's the Paladin quarterly looking?
Well, it was a big announcement today with Paladin, in addition to their quarterly report, because they put the quarterly out and they've also announced that this syndicated debt facility to the market at the same time. Paladin's capped at a whopping $3.5 billion, thanks to the buoyant market at the moment, and they're restarting the Langer Heinrich project in Namibia, which
Namibia's shaping up to be a bit of a potential district, isn't it?
it has been for a long time.
Yeah.
I think when you look at the deposits in Namibia, though, they're relatively low grade compared to and higher cost, and so there's a lot of Langer Heinrich's been around last cycle and obviously turned off, but there's other deposits in that area that have never been developed because they're low grade, but they're the ones that you see lots of studies done on over the journey, Matty.
Yeah. Well, Paladin was a stock that my neighbour up the road that was looking to buy cheap shares and looked at all these shares that she thought were cheap and bought Paladin.
They're trading at a couple bucks. They must be cheap.
Yeah, she's like, oh, no, they were like, and they went up. She's like, oh, I told you it was cheap. I'm like, it's a bloody multi-billion-dollar bloody company. Anyway, I tried to explain it and just saw glass eyes. So.
She's laughing now.
But anyway, she made money.
So, I mean, they're restarting the Langer Heinrich project in Namibia, which, per the quarterly report, which was released to market today, is 93% complete and targeting commercial production by end of this quarter. Oh wait, but that's just a bullet in the highlight. If you go to page 2, you'll see that they say lower contractor availability over Christmas period might make that early Q2 though. Oh. So I would say Q2 is my base case, but they still anticipate before Q1.
So Trav, you sort of peeled back the numbers here. Looking into Paladin, how much of the production will get the benefit of these buoyant uranium prices?
So 48% of the estimated production to 2030 is contracted already, leaving, in theory, 52% of Paladin's production exposed to, the benefit of the market prices now. But if you break down that contracted proportion of production, most of it has a market-linked pricing feature rather than a fixed rate. So
who's buying it?
That's with a Chinese utility, Matty. So
yeah.
And I think the interesting thing though is when you look at the proportion of future production that's contracted, the important thing to keep in mind with these with developers is, I mean, we did a bit on Calidus a few days ago, and I'm sure we're going to touch on it again today, given their quarterlies out. But what can happen in dynamics where your production doesn't actually deliver on what you forecast in your studies or whatnot? Then you might end up with a higher proportion of production contracted, and that's why Calidus has this massive kind of proportion of production going to their hedge book, but it wasn't supposed to be that way. They're supposed to be producing more. So that's just like a dynamic to keep in mind here as well.
At least in this sort of instance, it's not as atrocious with the hedging being locked in, given you said it's done at a linked to the market price.
Most of it is. Some of it's fixed, yeah.
So they'll cop a bit of a brunt. And what about the debt? They did a debt deal. There was some interesting terms or lack of terms there, I noticed.
So they've added some liquidity into their capital structure as they look to enter that ramp up period where sometimes not everything goes to plan. And so they've done this syndicated debt facility, which is US $100 million term facility, and then another $50 million revolving credit facility syndicated to both Nedbank and Macquarie. It's really interesting, right? There's this new trend which has clearly emerged, JD. We talked about it with the Australia Pacific Coal debt deal the other day. Mate, I'm sick of seeing these key term appendix with the key terms of the debt facility uploaded, and the most important freaking term would be what, Matty?
The interest rate?
The fucking cost of debt, 100%. What are you paying on the debt? Like, that's the most important number.
That's what happens when you get a home loan. You're like, we'll just sort that out later, right?
Mate,
Should be right.
That's not one of the key terms.
I'll look after you.
So, mate, if another company puts up one of these stupid appendixes of the key terms and leaves the most important term out, I will shame you.
Trav will come to your office and smack you on the butt.
I will give you a big smack. So Paladin have, of course, done that today, which has really pissed me off. And then, okay, let's look at their capital structure and their cash. They closed the quarter with US $61.7 million in cash. They're still spending a fair bit, as you can imagine, given the phase that they're in right now. And to be fair, it's not a surprise that they've done the debt deal. They mentioned they'd appointed Nedbank as lead arranger for a facility in their last quarterly. But if I were Paladin, I actually don't think I would have taken a debt facility here. And this might be a bit of a controversial opinion, and I'm sure the uranium bulls will disagree with my take here, but I would have simply raised it in equity.
You're talking about dilution, mate.
I know I'm normally not a fan of dilution, but I got 3 reasons why I would have done this in equity instead of debt at this point. Number one, they're trading at 1.3 times NAV, right? And that might be conservative or not. I mean, it's broker consensus NAV,
but is that NAV based on today's spot price?
It's whatever decks have been used by the brokers. They wouldn't run a flat spot price through it. They'd run some trailing. I'm not sure what all the decks are, but yeah, that's a factor. So they're trading at 1.3 times NAV. So definitionally, their shares are valued more right now than the company's intrinsic value that even the optimistic brokers are putting out there. So you should use that script when it's fully valued or highly valued, either to do accretive M&A or de-risk the business. And here I think they could raise US $150 million, easy peasy at a tight discount thanks to the buoyant market, which is minimal dilution. It's about 6% on my numbers thanks to their big market cap.
I suppose the contrary to that would be if they believe it's going to go to 150, for instance, and they're like...
Yeah, mate, well, if you're running a uranium company, you become a uranium bull and then you start believing... You believe the juicy upside, but
considering they're like one quarter off production,
I will articulate why I would be more prudent, and that's got to do with the effect that adding leverage to your balance sheet has, in these single asset developer kind of commodity businesses. I mean, like, have you ever looked at Paladin's share price over the long term? Like, you zoom all the way out, like to capture last cycle. Have you ever done that?
I sure have. It got pretty high.
It got pretty high, and even though it's like gone up massively in the last couple of years in particular, mate, it's still 85% down from those all-time highs. And you think, how the hell is that possible? That doesn't make any sense. Well, the reason is because Paladin had a distressed balance sheet because there was debt in their capital structure, and they had to recapitalize more than once. Yeah. And what does recapitalize mean? Well, you chuck a bunch of equity in to sort of, relieve the balance sheet stress, and that massively dilutes equity worse. And I think here's how I think about leverage in the context of mining assets. I think we touched on this a little bit with our chat with Alan Trench, but the companies that can really endure leverage and should have higher leverage are the ones that own assets that are in the lowest cost quartile, because they make money throughout the entire cycle. And then it's maybe a little bit paradoxically, it's the companies who tend to have assets which are in the higher cost quartiles, which actually have more leverage because they need it to get financed in the first place, typically. And those definitionally don't survive the entire commodity cycle. And if you look at, what are they bringing into production right now? Well, they're bringing Langer Heinrich into production, which is a restart project. Why is it a restart project? Well, because it's a high cost asset. That's why that's why it didn't survive the last cycle and just keep producing all the way through. And those sorts of assets, like if you had a real change in market dynamics, and heck, I'm not saying that happens anytime soon, but it's not the sort of asset that keeps producing the entire time, right? Yep. And depending on when and how long that happens for, and all the sort of factors around, look how fast lithium price came down, right? You don't want debt in your capital structure in those situations, because then you can get distressed, and then it's really, really painful for the equity holders. So I would have been more prudent. I would have just done it with equity and just been safe rather than sorry.
It's a gamble. It's a gamble on whether they think this is the one.
Yeah, and it's a
that's going to sustain, because everything else has been a boom bust very quickly.
Yeah.
And gamble's the right word there. And I think it's a good segue into Boss Energy, because they raised a bit of capital about a month or so ago, and we were thinking that's a pretty good idea to do at the time before we knew what they were actually buying or doing. We thought, look at their script, they know it's pretty expensive, and hey, it's gone up a bit. There was a bit, could have been less dilutionary, but who cares? They got it away, and they didn't put the overall business at risk.
$220 they raised. That's a good chunk,
including SPP. Yeah.
And that was to buy and a bit of that went towards that 30% stake in the in situ recovery project in South Texas.
That's right, mate.
US $60 for that.
Yeah, it hasn't come off their cash flow as at 31 December yet, but the money that's come in the door from the placement has. The Boss Energy obviously restarting the Honeymoon uranium project in South Australia there, which is an ISR uranium project. And like during the project, they produced first production grade uranium from their wells. They raised the 220 million, agreed to buy that 30% stake. And then they closed the quarter with Aussie 226 in cash, another they've got another $200 million worth of uranium inventory as well, which has obviously benefited from the uplift in value thanks to the uranium price. They indicate first drum of uranium expected this quarter. First drum, mate. I've got to understand the lingo.
Must be a bloody I don't think you can put uranium in the bags that they chuck the spodumene concentrate in.
Do you think
I think
first
they have
drum
to seal her up a bit.
Do you think first drum is the same as like first pour in gold?
I think it'd be the same as first ship,
right,
or something. Is that the drum? That's the first thing they can ship off. I think it's the first ship.
But you haven't received money for it yet. You've just got it.
I think so.
Right.
Yeah.
Okay.
Yeah. Happy to be informed. Right, boys, the MinRes quarterly came out today.
Gents, I get excited for the MinRes
Love
calls.
hearing a good bloody yarn from Mr. Ellison.
Yeah.
Right, a lot of moving parts in this business in a very interesting time in the market. I was exposed to these downward lithium prices, but exposed on the other side to buoyant iron ore prices. Take it away, boys. What did you think of it?
Yeah, I mean, I think the calls are really interesting. They've got great characters on them, so I think they're always worth tuning in. And like you said, a lot of moving parts. They've got, the mining services exposure, the lithium exposure, the iron ore exposure. So I thought it'd be good just to go through a couple of the comments that we heard from the people who ran the call, as well as a couple of details from the actual quarterly report that came out. So we've kind of cleaned up a few of the comments to make it more simple to understand. But let's start with the lithium assets. Now, this one's drawn straight out of the report. Wodgina, Mount Marion and Bald Hill are profitable at current prices. So on the call itself, the words positive cash flow were mentioned. Now, obviously, this isn't the same as being profitable. So
that's they were saying their operations individually are cash flow positive.
No, he used the word profitable, which you can't fact check in a quarterly that doesn't report profit.
Yeah, so I think it's because would you distinguish between cash flow positive for an operation and profitable means once you include every other bloody overhead? Are you adding free cash flow to the business?
Nah.
How do you interpret it?
Well,
what's the definition?
Profit doesn't. I mean, yeah, if you group stuff as development capex, you're not gonna see it in your profit. You only see the depreciation expense out of your profit. So you can be a bit cheeky with what's profitable when it's actually not making money too, depending on how you categorize your capex.
Exactly, and that's why I didn't like it and thought it was of note, because I think it's a bit too ambiguous, given that it's not supported by a whole bunch of numbers. And I mean, frankly, I find it pretty surprising that all of those three assets would be profitable at these lithium prices. But we'll see next month with a few more numbers coming out what he's actually referring to there. Mm-hmm. The next thing that I found really interesting was the wording and the sort of just the language around this bond. So they've talking about their love for the US junk bond market. Now they have a newly
they don't use the word junk though.
Well, maybe that was my word, but they've got a newly issued $1.1 billion US bond. Now the wording from the CFO around this was, it's covenant light. No net debt to EBITDA covenant is enforced. We need to pay our interest bills or we're in default. That's about it. So they were very keen to emphasise, because the call cut out at this point, and then rather than leave any ambiguity, they went back and repeated this whole section and really emphasised that covenant light aspect of it. So
it basically felt like the CFO's job was to come on the call and like quash rampant speculation about their balance sheet before it even comes up. It really felt like that was the intent of the CFO's.
And there was a bit of a jab at the old banking syndicates and how they would sort of monitor all these various covenants that they put on the money that they give out, really praising that bond market in the US. So,
but the balance sheet, mate, what did you think of some of the the numbers as they related to the debt?
That number really stood out. So they said net debt of roughly between $3.5 and $3.6 billion. Now, it wasn't clear to me. They spoke about wanting to sell their stake in Azure. They spoke about getting roughly 600 Aussie in cash from Albemarle, given the rejigging of that joint venture structure. So I wasn't sure how that sort of...
If they counted that or not.
Yeah, if that played in or not. But, I mean, first thoughts, that's pretty big. $3.5 billion. This is a sort of circa $10 billion company now. You've got Onslow coming on. It sounded like CapEx was second half weighted. Plus, is that all the CapEx that needs to be spent? Is there going to be a bit more in the second half of this calendar year? So I'd be very keenly looking out to see how much cash they get in the door from selling 49% of the haul road up there, and whether that can relieve a bit of stress, given that even if the lithium operations are bringing in some money, which, we've sort of spoken about already, but if they were bringing in any money, it'd be marginal.
Yeah, I thought that.
And
I think I'd read some commentary, might have been from City, that this was previously that they kind of thought there might be an announcement on that whole road, as early as kind of the December quarter, but that never happened. So now the guidance is they're going to look to announce a sell down of that in conjunction with when they bring on first ore there. Is that if I remember correctly? Which I'm not sure if there's a guidance mismatch there or not, but it kind of opens a door about that process and is it?
Yeah, I mean, going off today, we're expecting this half of the year an announcement on the sale of that. The CFO emphasised that it's an infrastructure asset going to a project that is going to make money through the cycle. So, I mean, Onslow's not known around town to be the lowest cost iron ore operation once it sort of comes on, but let's sort of see how much money, because I think that'd be quite important, the amount of cash that comes in and what that does to the net debt position. Another comment that stood out, gents, was Chris's comments regarding their involvement with junior miners, and I think we're talking specifically about lithium companies here. So the words were to the effect of, we are well and truly open to joint ventures or taking a piece of any company. Who else would you want on your register? Sounded a bit ominous to me.
I do love the way he phrases their strategy buying the stakes. It's all about adding the expertise, etc. Anyway, the market might not quite see it that way.
He unfortunately bought the stakes when things were in Maniaville, and now the bubble has popped. For how long we don't know, things have gone down by a third, they're a third of the price, Delta and things like that.
Yeah, you're spot on, Matty. But
except Azure.
Well, to that $230 million, they said, and they're going to free that up and sell into the bid, so that'll give them a bit of cash. I think you're spot on with what you said, Matty, but it's interesting to sort of see and hear their language around lithium. They're not backtracking; they're pumping money in, into all the assets, Mount Marion, into Wodgina. They're looking at costs coming down, unit costs coming down in the coming periods. They're talking about the sort of strategy of having the hubs and everything. There were some interesting questions about Bold Hill, although they didn't give too much away on that front.
Oh, it's just the beauty of being a big company. You can just rip out the immaterial and it's all good. Don't have to talk about it.
And Ellison spoke about his sort of enduring of 40 years of commodity cycles. So this is nothing new. And the last comment that stood out to me, guys, was give me another 12 months and it'll all be clear. Haven't we heard those words before?
Well, I think the last quarterly call when talking about Azure specifically, it was the AGM. AGM one. He said, look, obviously fantastic ore body. We love the ore body. Give me 6 months and you'll know the plan. But appears he's been pushed out of that one. So, and that would have been at the top of the list of the ones he wanted because it's the best ore body.
Keeps the cards close to his chest, doesn't he?
Yeah, so still, But, hey, give me another 12 months and to be clear, that is probably a reflection on it might take 12 months for lithium to recover if it does. So, it's probably a pretty practical comment, I think.
Yeah, might be some funding considerations baked into that,
Alrighty, guys, shall we rip into some gold?
Oh, gold. Trav, you're bloody dear to your heart, St. Barbara.
Oh, ding, ding, ding. Probably $2 of St. Barbara shares.
So let's remember, Trav only holds St. Barbara shares because we bought shares to call the investor line during the battle for Leonora. So
I had to spend $500. Yeah,
Trav is not a shit investor.
And you've stayed loyal as this is a deep value play now.
It is
deep fucking value.
It's really, I really hold it for sentimental value these days.
So, I mean, to give a bit of a refresh on what St. Barbara is all about these days.
I can't believe we're talking about them first. Anyway, how's it make it up here? God.
Not much thought went into
Not a reflection on the companies here that St. Barbara's off first.
All right, let's rip in. So they've still got Simberi, which they produced a measly 13,000 ounces from, as well as Atlantic, and a pile of cash. So those 13,000 ounces produced at, get this guys, all-in sustaining cost $3,890.
That's the only time we refer to all-in sustaining cost is when it's higher than the spot price.
Yeah, well, you bet there's some more costs coming in on the top of that one too. So they're a $140 million company by market cap. So the times have changed from just a few years ago. But $214 million in cash, you heard that right, plus $22 million in listed investments. Now, they've got restricted cash of $47 million. That relates to a reclamation bond at Atlantic in Canada, and likely another $43 million to go toward that. So that would total at Aussie dollars about $90 million. Now, what is the sort of EV of the company? So market cap, obviously, like I said, 140, plus the full bond, treating that as a liability that it is, minus the cash, plus a bit for those listed investments. That equals around about zero.
For the EV.
For the EV, and in my opinion, still a bit too expensive. Alrighty,
Mate, don't be
Regis.
so cruel to my stocks.
Right, Regis, 109,000 ounces for the quarter, on track for their guidance of 415 to 455, so no slouch on the ounce department. So 70,000 ounces of them come from their Duketon operations and 39,000 ounces from their 30% share in Tropicana, which is the other 70s Anglo Gold.
Yep.
So 9.7 thousand ounces came from Duketon North. That's the one that's finishing up at the end of the financial year.
Gotcha.
So those Duketon North open pits were the highest cost, but that's because they're ramping down and scheduled to cease. So the question was asked on the call, is there any closure or rehab liabilities for it? But they said it's going on to care and maintenance. It's not being closed. It's staying open for future exploration or anything. So there's no liability on it. So there'd
be a liability. They just are factoring it in.
There's
15 years down the track instead of today.
There's no liability coming right now.
The
but there's
NPV,
obviously care and maintenance costs.
Yeah.
Out of there, so they guided initially for this financial year 85 to 95 million of capex. They've already spent 73 of that. The question was asked as well, like, you know, what is this going to keep going? Are you going to blow the capex guidance for the year? But Jim, the MD, said in the investor call, it was he reckons the increased capex is on the back of, I guess, good performance, and sort of danced around the whole thing a bit, I thought.
Increased capex on the back of good performance.
Well, it sounded like,
we did good here. We get this here.
We're performing well, so we're going to keep pumping the capex in to brighten up the future. So it didn't explicitly say if they were going to curb the capex spend for the remainder of the financial year, but sounds like if the operations are going to be performing well, they'll keep putting the capex in while the cash flow's there. So, and as we said, growth capital, capex this isn't going to give you a benefit in 6 months' time. This is stuff for 1, 2, 3 years down the track. So different from sustaining capex. So look, it might brighten the future up for them when you do put it in now. They ended with $155 in cash and bullion, but they still have 300 mil of fully drawn debt, and that was the debt they got to buy their 30% stake in Tropicana. So that's where they paid IGO 903 million in cash for that in 2021. So they would have added 42 mil to the balance sheet, but they made the big move, which we highlighted previously, of closing out their hedge book. The hedge book was the big overhang of this company.
Totally.
Because that hedge was running at about half the gold spot price. So they closed out 63,000 ounces and those ounces were hedged at 1571 Australian.
Aussie.
Yeah, so half. So cost them 98 million. Looking at Timmy Mack's Canaccord note, he's from their calcs, they say the gold price will have to average 3,090 to not negatively impact the free cash flow for the remainder of the financial year. So it's at 30.72 at the moment. So if it averages that
for the buyout to have made
for the financial sense on their free cash flow predictions.
But there's more to the rationale of buying out that hedge book, and that's the fact that
of course
in June quarter they get to show this big bloody big operating cash flow that they never used to be able to do because of the hedge overhang's gone.
Well, and I was going to mention it later, but we'll talk about it now. Like the re-rate it'll give them, like, as we said, it was a big overhang, but like closing out that hedge book now opens them up to, I guess, be a bit of a re-rate for a share price, because they're fully unhedged now. They're not hedged to really shit gold prices.
It's like $100 million marketing expense to rebrand the company as an unhedged gold producer.
Exactly. So they might, whether they get it like a share price lift from this, just from, I guess, being re-rated, we'll soon see. Now, a lot on McPhillamys. That's obviously a big development project in near Bathurst and Orange in New South Wales, in the cold country. So The DFS is expected this quarter. They're targeting FID for June in 2024, but it's contingent upon this Section 10 application outcome. So the Aboriginal elders in that region applied for federal heritage protection of the proposed McPhillamys site back in 2020, still awaiting a response. Yep. So I think they're obviously pretty frustrated by how long this is taking.
It's the difference between building a gold mine in WA and New South Wales.
Yeah, exactly. Yeah. A lot of I don't know the ins and outs of it specifically, but still waiting. So that is going to obviously have an effect on funding FID and everything if that drags out. So that DFS is also expecting to, along with that existing 300 mil syndicated loan facility being refinanced to be paid much later. It was extended recently to 30th of June 2025. So I think they're going to try either build on that for future debt or kick it down the road a bit further. Gotcha. But that's all going to come out in that DFS.
I mean, do you reckon they're, they've obviously got lenders in place for that facility, and I'm sure they're advancing all of the works to be as ready as possible to start McPhillamys if and when they can get the go ahead to do it. Do you think the lenders, might have kind of indicative terms of what debt quantum could be and all the rest to kind of build on that existing?
Yeah, well, because McPhillamys is going to require 500 to 600 million. They're predicting of capex.
Right.
So, look, the comments on the call were they don't want to do an equity raise for it, but we'll talk about whether that might be partially a contributor to it or not. But it sounds like they're happy to fully debt from existing operating cash flows and extra debt to fund this operation.
You'd always say that though.
Yeah. So they're obviously I don't think they want to make that FID too early without having that funding sorted and pending this Section 10. So it's all a bit up in the air there. So
I reckon the ideal strategy for them would be, when that kind of gets approved, have the lenders and the facility all in place, ready to kind of just pull the trigger. You release it, you announce FID, and if there's a small kind of funding gap to be plugged by equity, you just do it on the same day and just bang.
Yeah, well, let's go through the hypothetical. They've got rid of the hedge. Hopefully going to get a bit of a re-rate for it. They keep making cash from their operations, sort out the debt funding or a good chunk of it for McPhillamys, and then FID and do a portion of equity while after the re-rate, because no point doing it now before it. If they do get a re-rate from it, no point doing it now and really diluting, and gold price might rip up if interest rates start coming down. So I think there's obviously a lot of balls in the court to see what happens, whether they do. But hey, as you said, if bloody price starts going up, and why wouldn't you tap the market for a bit of equity instead of taking the risk to? Because that'd be a lot of debt there. That'd be nearly $1 billion of debt they'd have on their sheet, depending on how much their operations come up with in the next couple of quarters. So,
mate, Regis might actually be exciting for the first time in a long time, just from corporate perspective.
Well, there was all the bloody word on the decline going around last year. I think I don't know if they were a bit of a M&A target. I think there was the talks about Gold Road Regis merger. God, I think I even heard someone say Westgold and Regis. So I think, with this development project in the pipeline, and obviously the stake in Tropicana, because that is a quality asset, even though they've only got 30% of it. And I think a lot of companies that think, we'll come on board with you and assist you with this McPhillamys development, but we'll see if it's they're going to make it happen themselves. So if gold can start tickling 31, 3,200, might be a bit of a perfect storm for them.
And I mean, there's a big binary bit of value there, and that's McPhillamys. Like, I don't understand if it's just you're waiting for something now, or if it's like a potential that you'd still be waiting in a decade's time or not. But that's a big bit of binary value that could.
It'd be interesting if that Section 10 comes through favourably, how the market reacts to it. But look, they're targeting 500,000 ounces by FY27 once that comes online. So they're a decent producer. Right, what else we got, boys? WAF.
West African. Alrighty, so cash flow from operations, $49 million in the quarter. Now they're developing their second operation, Kiaka. So they had capital outflows of 62 million across the company. So 53 of that was for Kiaka and 9 went toward Sembrado. Now the cash position overall moved back 17 million to 135 million, but they've also got 10 in unsold gold. Now they had their first drawdown of the debt facility that we spoke about probably 3 or 4 months ago. That was for US $265 million. So they drew the first 100 of that in early Jan. So that was after the quarterly had finished. Kiaka, it was great to see, is progressing on schedule and on time. So first gold is expected in the second half of next year. So things are sort of coming together quickly now for West African. 55% of the project costs are committed and fixed. And something they said stood out to me, no material cost inflation observed since the CapEx estimate was reported in the DFS from August 2022. So that's sort of great to see, and maybe we start to see a lot more of that across the market, across different companies, now that some of those inflation, attributes have come out of the market quite a bit. They signed off the quarterly, the front page, with 3 key objectives, which I really liked. It just makes it nice and simple. When you look at the next quarterly, what to look out for. So they're going to maintain Kiaka construction on time and on budget. They want to release their production and cost guidance and update the resource and reserves, plus a 10-year production target. So nice and simple for us to hold them to account in 3 months' time.
Very good. Calidus, boys. Well, looking forward to this one. What's going on at Calidus?
Calidus, we don't need to sort of flog the dead horse much more here. We've spoken about it quite a few times. The subheading straight away was a bit concerning to me. So 32 to 37,000 ounces targeted at an all-in sustaining cost of 2.1 to 2.4 per ounce. Now, we've gone in at length about the hedge position and about how it's very much in their interest to produce as much gold as possible. Looking at the cash side of things, they sold the Nullagine camp for $14 million in leasing inflows is what they got. So if you take that out for a second, their cash would have gone from about 15 down to 9.5. Now that's pre the financing activities. Ultimately, they finished the quarter with 10.8 million in cash and gold, $69 million in debt, plus the 83,000 ounces being hedged, as we've spoken about in the past, at $2,367 Aussie an ounce. So it doesn't put them in a great position given the weak production guidance that we've spoken about. They did mention they're looking to refinance that $69 million in the project loan facility that they've got, but wouldn't really be holding my breath. If you sort of scroll through to the performance of the mine, there's a number that really screams out, and it doesn't look good. From the 550,000 tonnes of ore that was milled, the head grade was 0.71 grams per tonne. I find it very hard to believe anyone can sort of make money at 0.71 grams per tonne, but let's sort of see how things progress there.
Yeah, God, they're hanging on by the skin of their teeth with $10 in the bank.
They sure are, mate. And they've got, debt repayments and all that coming up. So let's see how they go.
Oh, good old Spartan, SPR. Buddy, anyone holding shares now?
Yeah,
I actually am, yeah. Ding, ding, ding.
Oh, you're back in, are you, JD?
No, I had a little tickle that I meant to sell at 53, but they didn't go through and I forgot about it. So here we are.
Spewing. Right.
Not so bad, though.
Got to put a bloody... And look, the share price is going up on the back of this today a bit. No, nothing to do with the gold price. But they got $39 in cash. They obviously did that raise not long ago. So set up for a good year of exploration. But administration and corporate payments for the quarter of 0.4 million, down from 0.9 million. Now that is what we like to see, boys. And they even break up where it went. 0.2 million paid in compliance activities and 100 grand in conference attendance and investor relations, breaking it up for the investors to really show where these corporate costs are going. But the only thing I find interesting is the fact that if you look at this quarter, the total cash flow from operating activities, 2,326, and from the September quarter is 2,322. So the corporate costs, the staff costs and administration costs have gone down, but then it's all been the care and maintenance costs have gone up by the same amount.
Oh, might just be timing consideration. Anyway, I think do you reckon they've done it for the investors or they've done it for us after we scrutinised their lack of breaking down?
I see this as Mr. Lawson talking directly to us. So he's paying the staff $500,000 less, but the care and maintenance is costing more. So
For the money miners who didn't listen to an episode last year, we had a bit of a rant about the enormous
Corporate costs.
corporate costs associated with the raise that they did in December.
anyway,
Credit to them on the disclosure there.
but as I said, cash in the bank. They've got a big, I guess, a big definition program ahead about this never and what's below the Gilbey's pit. So, and the biggest focus for them at the moment is adding ounces. But the difficulty for that now, unless they find new lodes, is proving it up nice and deep, because we're getting down to, well below 500-600 meters to get further definition. Mate, I heard they're chucking a couple of wedges in.
Tell me what a wedge is.
A wedge. So you smash like a 3-inch hole down. I think you do the bottom to about 2 inch. So you can put a bloody 900 meter hole in, and then you can. So that's obviously one piece of core or chips that comes out, and then you put this wedge down, and it's like positioned in a way that once you hit this wedge, it'll sit on top of that where it goes from 3-inch to 2-inch, and it's angled in a certain way that as soon as the drill string hits it, it deflects. So from the same hole, you spray that hole out that way, pull it out, then you chuck another wedge on at a point on top of that, which angles it a different way. So from the same hole, you start spraying holes down everywhere. So it's a way there's obviously a cost associated with putting that wedge in, but it's much cheaper than having to drill a new 600 metres every time. So you could tail off bloody 10 holes or something from the one hole. So that's a good way to drill deep and define deep areas without having a shitload of exploration costs. So, mate, I'm a fan of the wedge.
The wedge. Imagine you lose a bit more ability to get exactly where you want. The deeper you go and the more you do this.
Yeah, but you still survey the holes and everything to know exactly where they are. So you're still getting the information. You're just sort of bending them through. So that's going to be the most important thing for them, is proving ounces up deep. Because at the moment everyone's like, it's 1 million ounces is going to be big enough to turn the plant back on, yada yada. But they need to prove up a big resource. But the deeper stuff you don't get till a while later, but makes them a bit more saleable or something like that. So good work on the corporate costs, Simon. Right, PMET. Kenny Brinsden, the bloody grandfather of lithium, you'd say in Australia. He's moving from non-exec chair to CEO MD and moving to Quebec. Blair Weiss stepping into the COO role. So hope you enjoy the cold, Kenny.
And see what they do from there. Not much more to say on that, but
yeah, I think they're probably similar to Wildcat, just drilling all year and hoping lithium turns around.
Except you can't drill all year.
Oh yeah, you can't, can you? Well, you drill in winter.
Yeah. But drilling half the year.
Drilling half the year and talking to people for the other 6 months.
Yeah. All right, last but not least, gents, Arafura, they came out with a interesting sort of announcement.
Yeah, I had to chuck this in because one of the money miners on YouTube just keeps asking about it. And given they've reported today, I've cast my eye over it. Not too much to report here. Stock has been really beaten up, down 80% from February last year. They maintain in the quarterly some commentary that they're continuing to target completion of project finance for Nolans in the first quarter of this year. If I were a betting person, I'd say achieving that looks increasingly unrealistic. I've got 3 reasons why I reckon that.
There's one of them that it's like $1.5–2 billion.
Mate, 4 reasons. Mate, rare earth market's pretty bloody beaten up. It's it's not buoyant, so financing anything's pretty tricky. Number 2, the appetite for bringing on new rare earth project, I feel like has really shifted in the last 12 months. It's like, it's no longer the Arafuras and the Hastings or whatever that are the next cab off the rank. It's totally now the Brazilian rare earths look to be the undeveloped projects that could come online instead. And those are the ionic clays, which apparently have a unique kind of cost advantage. And then point 3 is I don't think any lenders are still yet comfortable when your customer is China, and that's a huge component of just you need offtake, you need it in place, who's the buyer, etc., and frankly the only buyer is China. So.
Right, boys, good stuff. Right, we've got to rip our Q&A after this. Exciting.
Get into it.
I'm going to get shit-faced for that, I reckon. It'd be bloody great. Right. Thanks to all the partners, as always. InvestorHub, DSI Underground, Terra Capital, McMahon Mining Title Services, Future Proof Consulting, Anytime Exploration, KCA. Never say no to anything. Brooks Airways.
And K-Drew.
If you want a hobby farm, give Brooks a call.
Hoodaroo.
Hoodaroo.
The information contained in this episode of Money of Mine is of general nature only and does not take into account the objectives, financial situation or needs of any particular person. Before making any investment decision, you should consult with your financial advisor and consider how appropriate the advice is to your objectives, financial situation and needs.